Hi everyone, this is a technical analysis on USDJPY. Let's start with some fundamental background first. In the US, the Fed left the interest rates unchanged as expected at the last meeting, with basically no change to the statement. The dot plot still showed three rate cuts for 2024, and the economic projections were upgraded with growth and inflation higher and the unemployment rate lower. The US CPI beat expectations for the third consecutive month, while the US PPI came in line with forecasts. The S&P beat expectations across the board, although the average hourly earnings came in line with forecasts. The USSM manufacturing PMI beat expectations by a big margin, with the prices component continuing to increase, while the USSM services PMI missed, with the price index dropping to the lowest level in 4 years. The market now expects the first rate cut in September. In Japan, the BOJ finally exited the negative interest rates policy as expected at the last meeting, raising interest rates by 10 basis points, bringing the rate to a target between zero point 0.0 and 0.10%. Moreover, the central bank scrapped the yield curve control and ETF purchases while maintaining QE in place. The latest unemployment rate missed expectations, although it continues to hover around cycle lows. The Japanese PMIs improved further for both the manufacturing and services measures, although the former remains in contractionary territory. The latest Japanese wage data came in line with expectations. The Tokyo CPI, which is seen as a leading indicator for national CPI, came in line with expectations. The market expects another rate hike from the BOJ this year, although the timing remains uncertain. Now, on the daily chart, we can see that USD/JPY finally broke out of the consolidation following another hot US CPI report. The breakout of this big ascending triangle could point to much higher prices ahead, with the buyers targeting the 160 handle. The sellers will need the price to fall back below the 151.92 level to start looking for new lows, as the buyers are now in full control. On the 4-hour chart, we can see that from a risk management perspective, the buyers will have a much better risk to reward setup around this trend line, where they will also find the 38.2% Fibonacci retracement level for confluence. The sellers, on the other hand, will want to see the price breaking below the trend line and the 151.92 level to invalidate the bullish setup and position for a drop into new lows. On the 1-hour chart, we can see that this recent price action formed a rising wedge and diverged with the MACD. This is generally a sign of weakening momentum, often followed by pullbacks or reversals. In this case, it could be a signal for a pullback into this trend line and the Fibonacci retracement level. Therefore, if the price were to break the wedge to the downside, we can expect the sellers to pile in to position for a drop into the trend line. Today, we conclude the week with the University of Michigan Consumer Sentiment Survey.